Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table.
Welcome back. You're listening to Money on Tap. I'm Ben Brayshaw, and I'm here once again with Dan Michelon. How you doing, Dan?
I'm doing well.
Good.
Doing really well.
Good. Crazy world out there. People have questions. You might have questions. Give us a call at 855-226-8551. Again, that's 855-226-8551. Or email us at info@yourmoneyontap.com. Really great to have you all back with us again today. We have really a great show ahead of us, a topic that is huge and growing on us daily.
A topic you truly cannot avoid.
Inflation. We're talking about how to inflate your portfolio today and how to combat that in a way that you find profit margins and profit centers and where you can look to make money in a crazy world of inflation and the stock market crashing around us left and right. Yeah,
it's it's hard to find good news out there, but the truth of it is there are ways to design your portfolio to, certainly offset what's going on and potentially profit from it.
Yeah, there's a lot of things going on. I mean, it's interesting. You see, Walmart and Target crashing around us, and then all of a sudden you see some other company going up 20 or 30%, and it's how do people look at these things and say, how do I get into that and get out of this? How do I mitigate that? And there's a lot of questions around that, and there's a lot of conversation around kind of untraditional investments that we're going to talk about today too. That bring some opportunity to it and to managing your wealth overall. The world is all about stocks and bonds, and that's kind of the focus of our conversation most of the days. But there are other ways to make wealth that sometimes are intermingled with the stock market, and sometimes they're not. And we're going to bring all of those together today.
Yeah, I mean, the markets and the investing world, they're cyclical. Things are sometimes up, sometimes down. We're coming off of a strong decade in the growth world, right? That's been the flavor of the day for a long, long time. And, if you've been positioned that way in the last, excluding the last couple of months, but for the last 10 years, you've done very well. But things have changed. The tides have turned, and, it's probably appropriate to consider other options.
That's for sure.
Yeah.
But before we jump deep into the show itself, we're going to start off with money in the news.
So first up, we got an article from CNBC. This is from Pippa Stevens. And the headline is, California's gas average tops $6 per gallon as prices surge across the U.S. And it seems like California always leads the way in these price increases. And $6 is certainly a scary number. But there's no doubt about the fact that, fuel and energy costs are just going up. And that's, contributed to by a number of factors, primarily inflation and just the global markets in that situation with obviously the geopolitical stuff going on in Russia and Ukraine. It's a supply and demand issue. But those numbers are, really concerning. And it's something that is one of those unavoidable costs for most of us that travel by car and, heat a home or in any way use byproducts of the gas and oil world.
Yeah, I mean, obviously we all know we're paying more at the pump, and everything that gets shipped to us costs more because of that too. And diesel fuel is just out of control, which is the heart of shipping. I think it's sad. There's a lot of things going on here. I mean, I don't know if you saw last week, Biden had another cut back on how much oil production can come out of Alaska. I don't understand. I don't understand that. Just on Thursday, there was a refinery explosion in Korea, which they think is going to further tighten the gasoline and diesel markets. And, just goodness gracious, every time you turn around, it's like another problem around all of those things. And then you think about the shortages of food and baby formula you hear about, and and then and all of a sudden you got fertilizer problems. I mean, the amount of things that are kind of ramping up around us is a little scary.
It sure is. And, it's not in this article. It's not referenced there specifically, but, I saw something else as I was just kind of leafing through the news of the day that in Washington State, they're actually out of gas at a lot of pumps, and they're looking at, forecasting $10 a gallon prices there.
Yeah.
Which is, that's insane. That will really make it very difficult to conduct life and do all the things that we're used to doing.
Or ship those protesters out of there to other states.
Yeah.
That might help a bit too.
There might be some benefits, right?
Yeah. We'll make it $10 and then don't have to worry about pollution. So, anyways, well, speaking about, we have this world from an investment standpoint. We've been big energy investors for years now and enjoyed its benefits in a lot of ways. But, you have the other side. You have the ESG side, which is, kind of the socially responsible energy marketplace. It's very, very edgy to talk about ESG investments and the idea that, you're being energy socially responsible. I think that's
environmental social governance
yes.
is what it stands for. So it's your kind of green/woke investment opportunities.
So, the funny piece about this is this article here, which is from Fox Business, and this is Lucas Manfredi, talks about how Elon Musk and is tweeting about the fact that essentially Tesla is not part of the ESG anymore. The idea that, what was his quote, Dan? Do you have that handy? The idea that, he tweeted, he goes, increasingly convinced the corporate devil incarnate. He's talking about the ESG rules around it. He's basically saying that there's no way Tesla can not be part of ESG, and yet Exxon's in the top 10.
Yeah, it is kind of funny to see that when you look at the lists of who comprises this index and who the major players are. That the number one manufacturer of electric cars and kind of, it's the brand name associated with the whole EV movement, right? It's Tesla, right? First and foremost, that's who you think of. And they're off of the list, but Exxon, your major oil producer, drilling and fracking and doing everything they possibly can, they're in that top 10 list.
Quote, Exxon is rated top 10 best in the world for environment, social, and governance, ESG S&P 500, while Tesla didn't make the list. Musk tweeted on Wednesday, quote, ESG is a blank has been weaponized by phony social justice warriors. SP Global Ratings has zero integrity. It is really kind of, it's almost like they're trying to punish Musk for a number of the recent tweets he's had that have not been leftish at all. And it's just really interesting.
I'm usually pretty slow on the draw with this conspiracy stuff, but, Musk is really kind of bringing some of the stuff to light.
Yeah.
It's amazing. He gets involved in Twitter and all of a sudden it's like an avalanche of bad news for him. But, it is truly amazing, though, just speaking of this guy's persona and his accomplishments. He's in the news as much as inflation. Honest to God, you can't flip through a page or open a website without reading about him literally every single day.
I know, but the thing is every time he's talking about something, I don't really disagree that much. Most of it, I'm kind of like, yeah,
No.
He's like, I want to bring Trump and everybody else back to Twitter, and he's like, free speech, and everyone's like, no, we don't want, that's not free speech. And I'm like, well, no, that actually is free speech.
No, he's got a knack of stating things simply and honestly, agree or disagree. He's convicted by his ideals and he follows through. He puts his wallet where his mouth is, and he takes things to completion. So you got to respect that, even if you don't necessarily agree with all of it.
He basically learned his lesson, he said, and he's voting GOP next time, Dan. That's what I heard. So it'll be interesting to see. Well, last on our list today, we've got 3 lessons from Warren Buffett worth paying attention to right now by Eliza Dernan.
Yeah, another guy who you can laud for his consistency, for sure. And he's been doing this a long, long time, and it'd be tough to point to anybody in history who's been better at investing. Honestly, I can't think of another name that flies off the top of the head here that could stack up with the resume that he's put together. But, so coming from that perspective, if he's giving you guidance in simple form, it's always worth paying attention to.
Yeah, I mean, he's got enough wisdom behind his background that I'm not a huge Warren Buffett fan, but I mean, some of his stuff is just a kind of basic savvy general pieces. And I think he has 3 items really quick. Inflation is out of investors' control. I think kind of accepting that is a really interesting part of focusing on that. I think that's something we obviously know. But another thing that I tell people all the time is understand that you're never going to buy at the low and you're never going to sell at the high. So after you sell a stock and you're happy you made some money, don't keep watching it continue to go up and up and up. If you're satisfied with what you made, realize that you're not the person pulling the strings on some of this stuff, because highs and lows are set by massive investment. Like there's a huge influx of buys that are just driving the price up. Like a Warren Buffett says, I'm buying XYZ. He just starts buying. There's not enough people selling. And it just keeps pushing that stock price up.
I mean, the things you have to credit him for, is certainly number one, he's had the long view, right? I mean, he's been doing this a long, long time. So he's seen the cycles. He's seen high inflation. He's seen every market condition that we've experienced in the last 60 years, 7 years, who knows how far back it goes. But he also doesn't just trade, right? He buys companies that he believes in, and he holds them. I mean, he truly gets invested.
For like decades upon decades.
Yeah. So if there's something he's seeing that he likes, he's not always right. I mean, and there's certainly articles you can point to where, some of the investment moves have not been successes. But if he's taken a major position, it's always worth noting, and it's always worth another look.
Yeah. I also think it's interesting, too, that Warren Buffett just goes to number 2, which is index funds can provide simple and effective diversification. Buffett's not buying really index funds. He's creating his own index. Right. He's creating his own diversification. But I think he's speaking to everyone else. He's just saying, hey, listen, diversification is just a really, reasonably wise. You're not going to be able to pick enough stocks to really balance yourself out properly, because you're not going to have the wealth level to do that and to really have the acumen to, competently get those choices.
It's another long view statement.
Yeah.
If you're not an expert stock picker, then buy the indexes and ride it out.
Absolutely. And then number 3, value investing can be a solid strategy. Now, we talk about this all the time. I mean, I would tell you that our value portfolio is the one that has done the absolute best over this last period. We've enjoyed that, and I've seen some good options from that recently. So that's really where I think, in a market like this, focusing on dividend yields, looking for yield, looking for assets that are bringing value back to you is important.
If conditions aren't right for price growth, which I think we're certainly in a period like that, own stocks that pay you to own them.
Yeah, exactly. I think that's one of the things when you've got, and I say it all the time, like demand is there. Like there's all the demand in the world. The problem is we don't have the supply. Like the world's moving forward, so these value companies, they're sold out. I mean, they just have to get everything everywhere. Like the people that need it will still need it whenever they get it there. So there's a lot of that, and value stocks are really the driver in that space that bring the most opportunity. So
if you have a company that's got cash on hand to ride this out and continue to pay their stockholders, they're far more likely to survive these circumstances than a company that's still scrapping for capital and has to pay more and more for it every day.
Yeah,
that's a bad position to be in. That's probably not where you want to be invested.
And for our listeners that are thinking about, hey, why is the tech market getting hit so bad? And then interest rates on mortgages are going up, and it's like, you're right, Dan. They got to borrow capital to keep their business afloat for the next development piece, or building or expansion or develop. And that they're paying more just to have that money on hand. And
it's just going to get considerably harder to pick the winners in that world.
Yeah,
I really believe so.
Yeah, but it will flesh out the losers.
Yeah. And for those that are the more sustainable and the better quality in that field of growth and technology, it's fair to say that they're discounted now. If you can pick the right ones, you're getting them on sale today. Yeah,
that's for sure. And I think that's one of the other things. The long view of this world right now specifically is saying, if I've got 3, 5, or 10 years, and I like the price of XYZ stock today, it might not be the number one discount price, but it really might be an opportunity to continue adding to your portfolio. Because some of this stuff I look at and I say, some of these PEs are really low. I mean, some of these, we did a whole show on this. I mean, some of these numbers say, I'm a buy.
If you could find a PE less than the market and it's paying a dividend, why not?
Yeah, exactly. So, well, that's going to do it for Money in the News. We're going to be right back with how to inflate your portfolio. Stick with us. This is going to be a good show. We got a lot of information and a lot of ways that you can go out and figure out new ways and investigate new ways to make money. You can reach us at 855-226-8551. Again, that's 855-226-8551. Or email us at info@yourmoneyontap.com. We'll be right back.
Ben, how often do we have somebody come into the office and they don't have a financial plan? And how critical is it for us to put the pieces together and make sure that their future, their retirement, is a successful experience? We talk about it all the time here at Money on Tap. If that's you, give us a call at 855-226-8551 or info@yourmoneyontap.com. Whether you have 100,000, 500,000, 5 million, look, folks, we have the right planner for you. Whether it's Ben or myself, Seth Krussman, we're here for you to get the plan together and make sure that that next step is right.
Now back to Money on Tap with Ben and Dan.
Welcome back. You're listening to Money on Tap. This is Ben Brayshaw, and I'm joined here once again with Dan Michelon. As we enter the core portion of our show, how to inflate your portfolio in this kind of inflationary time, it's a big question for a lot of people, and a lot of people have concerns about that. If that's something that's ringing true for you, if you can, feel free to give us a call at 855-226-8551, or you can email us at info@yourmoneyontap.com. If you have some show ideas, we love show ideas. So we've had a few that have really come through that are strong, and those are actually coming up here soon. But email us, info@yourmoneyontap.com. We'd love to hear what you think. We'd love to hear if you have topics you want more information on. We can provide you with that and so forth. But as we jump into inflating your portfolio and the kind of the overwhelming demands of inflation that we're all suffering from, and I would say suffering because I know there's people who are just literally trying to figure out how to make it in this world. And then with this massive inflationary event, we talked about the price of gas, Dan, right? We talked about all the different things going on, and people are just trying to survive.
Yeah, I mean, just understanding that, just based on the CPI, the cost of goods is up somewhere in the neighborhood of 8 to 10%, depending upon what you're looking at. And the reality is, prior to this inflationary period, which has been not quite transitory, people didn't have, on average, 8 to 10% excess money in the budget. They weren't saving at that rate. So clearly, just looking at it from a simple perspective, people are having to do more of the same with less.
Yeah. I think, Dan, a lot of people understand inflation. It costs more. But I think we should talk about the types of inflation. I think we should kind of break down kind of the different components that inflation has. Now, inflation, there's three of them. There's three different types of inflation. And the first one is the demand pool inflation. So the demand pool inflation, do you want to step in here, Dan?
Yeah, I mean, what that means is that, when demand outweighs production capacity, there's more demand for goods than there currently is supply to meet that demand, which we hear all the time, right? People talk about supply chains, right? And we've all experienced, whether it's baby formula or, going back a couple of years, toilet paper, or just all goods in general, cars, used cars. There's pent-up demand. There's not enough supply. That causes prices to go up. Pretty simple equation there.
Yeah, and I think that's the one that we're all kind of familiar with. And we chatted about it a little bit earlier. The demand is there. I mean, they just cannot get the product to us. They can't make the product. You got China,
chips, commodities. I mean, you name it. It's all lacking.
I mean, there's just, and it seems to me that every time I turn around, there's another event that creates another, break in the chain, right? We've got between, everyone understands Ukraine. They talked about wheat. They've talked about all those different pieces. And then on top of it, you've got, we've heard about factories getting destroyed. We have shipping problems. We've heard of, China's been shut down for their version of a new strain of COVID or something. So they had factories that aren't producing again.
I remember a year ago when that boat got stuck in the canal and everyone was panicked over that. Look where the world's gone since. That was one boat and one passageway, and that was a global problem.
Yeah.
Now we have that. Every time we turn around, we're looking at something like that.
Yeah, and then on top of it, we have the price of diesel the highest it's ever been, and that is the shipping world of the United States, right? That is everything.
Yeah, so supply. That's kind of inflation category number one, just the general supply-demand factor.
And that really just brings us right into the second one, which is the cost/push inflation. And the idea that it just costs everybody more to either create it or get it to you. And so you have these things, it's kind of like this nasty circle, like one begets the other and begets the other. I think of, it's...
And they both drive price up.
Yeah, and they both, exactly. And they just kind of pushing each other and pulling each other, and it's dragging you around. But the idea that, diesel is more expensive and it's costing everybody more money. Like even if it takes the same amount of money to produce toothpaste for Procter & Gamble, okay, that has no oil in it, it still takes oil to get it there, right? It still takes that crude oil to get it going. So, and no matter how much green energy we create as a world or as an economy, as a country, we still use more and more oil every year. So like when you add that component to the fact that we have that, and then on top of it, Russia's like, we're not providing oil.
Well, nobody wants to buy it if they could. Well,
yeah, China will.
Legally anyway, right?
China will at a discount. And then finally, Dan, you want to jump into the third?
Yeah, the third is built-in inflation, and this comes when the workforce demands higher wages to combat the higher cost of living, which is basically points 1 and 2, right? So when we're all feeling the pinch, at the price counter because supply and demand is factoring against us, when companies are raising prices because they can't, get the natural products that they need to create what we ultimately buy, well, then the worker starts complaining that they're not making enough to survive. And that's just another level of price increase pass-through that we experience, as the consumer versus the corporate world. And I think very clearly we're already experiencing number 1 and number 2. And I think 3 is, if we're not there, it's right around the corner. You can see anywhere, help wanted signs all over the place. Average salaries are rising. So employers are simply faced with the fact that in addition to their increasing shipping costs, their increasing production costs, they're facing a third cost increase, which is the workforce cost.
Which is, hey, listen, if everything's costing everybody that works for you, 8-10% more, and honestly, the real rate of inflation, the government tells us it's 8.5%, but we did a real inflation rate show many, many years ago, and government said they're keeping it down and so forth, but it's well over 10%. And honestly, if you drive for a living and you own your own business and you're a transporter, it's hard to raise your prices because you're trying to compete. But but based on how much travel you do, you might have an inflation rate of 40% in your life. You might be that person.
Gas is up 50% year over year. We know that,
right? So, for everybody, it's a little bit different, but it's hitting everybody. That's the thing. And I think that's the hard part to really understand.
I think there's in the last month, we've seen a slight downtick in the velocity at which inflation was increasing. So there are some positive indicators. But at the same time, when you look at, these 3 categories of inflation that all, find their way to the checkout counter, I think the first 2 we're facing head on, and the third one is yet to really be factored in, but it's coming.
Yeah, I think when all of a sudden all of these companies that are paying more for oil and gas, trying to get semiconductors and the various other items we're going to talk about in about 3 seconds, and as they're trying to get that, and then all of a sudden all their employees need more income, it's just like they're going to be like, what do we charge? We don't even know where this is going. It's running out of control. I think the thing is that we keep talking about is that the Fed is probably going to drive us into a potential recession. That could happen. There's a 38% chance, according to, I think it was either Goldman Sachs or Morgan Stanley, that we're going to hit a recessionary event in the next 24 months. Those are real concerns. Everyone has them. Everyone's wondering what they're going to do. But I just don't really think that raising rates over and over and over again for something that where the demand is so high, that's going to just drive, it's going to drive control around inflation. That's not the point. The point is that we have demand at the quantity we had because we had 2 years of shutdown globally, and the world was still moving, and they still needed replacement computers, and they still need cars, and things deteriorate and they need to be replaced.
Yeah, I mean, they're using the kind of tried and true historical remedy here, which hasn't actually always worked out so well. But I think this inflation period that we're in is just atypical. It's not the natural cycle of markets, in this global economy that we have. It's been, basically brought about between the pandemic shutdown and the government response to it. These are the unique circumstances that kind of the traditional fix might not be the right one. Exactly.
And I think we're going to have some good back and forth here over the next 6-7 topics that we have here to talk about for inflating your portfolio. The first one we have, is kind of the go-to, I think, is the, commodity space, the gold, the silver. That realm has constantly been something that people have said, you know what, in a really inflationary time, we want to own a commodity that's, good for, my portfolio, and I can kind of rise with that. And, if the US dollar is not making money in the bank, I've got this asset. What do you think about that, Dan?
Well, it's it's another time-tested solve, right? I mean, in every hard time, people retreat to gold. It's a tangible asset. It, generally speaking, retains its value. It used to back up the dollar. So there's a lot of things about that I think are that safe haven to run to. But more interestingly, I think, are maybe some of the other precious metals, the silvers of the world, that have industrial applications as well on a larger scale than gold does. And the commodities world, I think, is a good place to be in, because there are certain things that, regardless of price, the consumer needs and will buy.
Yeah.
It's food, and it's fertilizers. It's the things that are used to produce food. And so some of those just core gotta-have-it products are all sourced from natural resources, from the commodities we're talking about. And that's a place that, comparative to speculation and fluctuation in the market, that is just more likely to retain its value, likely grow, certainly, well, can't say certainly anything, but less likely to lose its value.
Yeah. I will say, though, it's kind of interesting when you really break down the idea that, gold did peak. It did have kind of a very high point in kind of, mid-April, and it's retreated. Like, people sell, they're like, hey, listen, everyone's fearful about inflation, blah, 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 and then all of a sudden gold has a huge sell-off. So it's interesting that people have been holding it for a while and carrying it on. I would tell you that I don't see between, we were chatting about this earlier. I mean, it's like, no big surprise, but gold and silver haven't really done the ultimate carry forward investment. It hasn't been the sticky, hey, we're still in this inflationary environment. Everyone's talking about it continuing to inflate. Everyone's talking about continued problems, and we don't even know what the repercussions. I heard Apple is talking with China because they need chips. They have these problems. So we don't even know how bad this is going to get. But gold's not continuing to rise. Neither is silver. It's retreated. So I think that's interesting, because there's been a lot of conversation about whether, gold or, some of these electronic currencies and all this different stuff that, are those the hedge against inflation? And I'm not necessarily seeing the evidence for that.
No, I mean, we are in unique times where it seems like every investable class is suffering right now. But, has gold been the solve? Well, it's certainly not keeping up with inflation. We know that. But at the same time, it's outperforming the market by 15, 20%, depends which index you're looking at.
Yeah, I totally agree, Dan. I think that's the thing, right? We're just trying to find things that are going to help mitigate the inflationary issues we've got is really the focus, and, finding how to deal with this inflation and not watch your portfolio also go down. But next up, probably one of my probably one of my favorite ones. I think we've done shows on this. We've talked about it a lot, but we've talked about kind of the large cap value portfolio space. You want to talk a little bit about that?
Yeah, I mean we hit on it earlier, right? There's certain stocks that are mature companies that have cash on the books that are positioned to ride out these difficult times, and they in fact own you or pay you to own their stocks, right? So it's something we've talked about and we use in practice every day in terms of how to create income. And we're talking about is dividends here, right? So these value companies, these mature large companies, they pay a dividend, and that is really one of the primary ways to combat inflation. Historically speaking, in inflationary times, the stock market, the equity world does well. But right now, that's not the case. So you really have to, pick pretty carefully where you put your money if you're going to remain in equities. But the fact of the matter is, cashing out and running to a bank account or a savings account doesn't really make sense either, because then you get dealing with zero return and zero potential return versus the cost of everything, right?
Yeah, and I think what a lot of people miss about the value space, that dividend world I love the dividend world. It's one of my favorite places to operate, because there's always kind of like that new money coming into the account to reallocate, to reinvest, to do something with. What people don't really understand, or I think they miss, is the idea that if you had a $100,000 portfolio and your dividend yield was 5%, so you have $5,000 coming in each year. Now it might come in quarterly, it might come in over an annual, it might be all different. Some pay monthly. And you got this money coming in. The truth is in a market event like now, and however long this pullback happens, you're using that cash to buy more stocks that pay dividends as well. But as these stocks pull back, they pay their dividends based on how many shares you own. So if you can buy more shares because it's cheaper and you have the same amount of dividends coming in, you're actually buying a stock that pays you even a higher dividend than the stocks you bought before it pulled back.
Yeah, it's a way to continue to own the stocks you like and just continuously buy them cheaper, even if the market falls, even if their value falls. I
mean, we've watched Microsoft drop from 320-ish to 250, 240. It's taken a huge hit, but I don't think anyone thinks Microsoft's going anywhere.
No, and you can offset that as well with short-term bond portfolio, right? So, the stock bond mix is very common in any portfolio construction. We've been here hedging away from bonds for quite some time, just because they've frankly underperformed for a decade.
Yeah, it's like dragging an anchor across the bottom of the ocean while you're trying to sail a boat.
Zero interest, borderline environment. There's really hasn't been a reason to be there, but in the times now, a short-term bond fund where you have a predictable coupon or a predictable rate you're going to get off of it is a reasonable place to go. Now, long-term bonds, you probably don't want to go there, because as a general rule of thumb, as interest rates rise, the value of those bonds decreases, and we know the Fed's told us point blank they're going to raise rates, right? So, you got to be looking at things that are the shorter duration, that'll be less impacted by a current raise in rates. But that mix of dividend-producing stock and short-term bonds, can come out to be a nice portfolio construction in difficult times.
Yeah, and I think that's been interesting, because we've used, I think you made a really good point, we've used in our own portfolio construction the idea of using large cap value dividend stocks in replacement of some bond holdings, and talking to clients and saying we want to move up a risk level because we really feel owning XYZ blue chip bond is not as good as owning XYZ blue chip stock dividend. I don't think the company's going either place. Can I guarantee that? No. But but bonds are considerably safer theoretically. So, but depending on the company, it really depends on whether that company's going somewhere or not. So that's been a conversation that's really, I think, been good over the last few years, and it's benefited us. But it doesn't mitigate the fact that bond exposure has been difficult over the last number of years in any portfolio, even some of the tactical bond work we've done. So that brings
a little teaser for the next show, or a show coming up. We'll talk about these target date funds and their preset bond and equity mix, and what other opportunities exist.
Yeah, no, I think you're right, Dan. It's going to be great. Number 3, this is probably almost every Joe out there seems to own a piece of real estate. I don't know, Dan, if somebody has a rental apartment over their garage, they've got a 2-family, a 3-family, they own a commercial building. Everyone has real estate. I think the real estate piece is something that almost everyone feels like they understand. Like, hey, listen, real estate just kind of seems to inflate with the value of the economy, right? The inflation's going up. My real estate's worth more. And guess what? I get to charge more in rent as real estate goes up in value because I can sell it for more. Somebody's going to try to equate their costs inside rent. So therefore rents around the area are going up.
And being a property manager and a booking agent has become easier, right? Because now all of a sudden you have all these internet platforms that'll essentially do it for you at a cost, but it's time you don't need to spend. Whereas in the past, if you had that apartment, you had to chase down tenants on your own, right? And billing becomes an issue and maintenance becomes an issue. There really have been a lot of companies that have kind of popped up that really do make that their business.
And I've had clients who have said, I've gone away from renting to somebody over the course of a year because I can make more money through in Airbnb or VBRO, and I don't have to worry about tracking these people down for money like you're talking about. And honestly, on the short-term rentals, I get paid more. It's a little more work to clean and stuff like that, but it's considered just easier.
Yeah, I think that's a real opportunity for people, and especially if you have that real estate already. Prices spiked with real estate.
Forget whether you have the real estate or not. You could be renting an apartment from somebody and renting a room out.
Yeah, that's true.
It's like you don't even need to be a real estate mogul. You could just be, hey, I've got an extra room for a night if somebody wants to buy. So it's definitely interesting. I actually, that's a real scenario. A friend of mine went to England and he rented a room from somebody who was renting an apartment. It was just, I thought it was absolutely bizarre.
You do see lots of stories about that.
Yeah. So, so real estate's really interesting. It's a regular stream of income. It also provides great opportunity to have new assets that you could then redirect, maybe away from something else, but into the stock market. People say, hey, listen, market's down. I've seen people leverage real estate, not something I really recommend, but leverage it to invest into the market because the market's down. I've seen people take the revenue streams from real estate, put those in market investments because it's down. But most every one of those people look for dividend stocks for the same reason, looking for a return for income streams.
I think that's something that once you get a taste of it and begin to understand it, almost regardless of what the asset itself is, but when you stumble into the fact that there are assets out there that can pay you to own them, it's just, that's the win-win, right?
Yeah, it is. It absolutely is. You're listening to Money on Tap. You can reach us at 855-226-8551. Stick with us. We're going to be talking more about ways to inflate your portfolio through this inflationary environment. And we've got a few more and some really good ones coming up too as well. So you can also email us. You got show ideas, feel free. Dan mentioned one earlier. info@yourmoneyontap.com is our email. That's info@yourmoneyontap.com. We will be right back. Talk to you soon.
For a number of our listeners, they have a lot of questions, and you might be one of them. Today, we're just offering what we call Zoominars, webinars over Zoom meeting rooms where we have top experts, Social Security, estate planning, and financial planning experts for you to speak with, do a private consultation that way today. We're also having webinar-based Zoominars where we're going to have multiple groups where you can be part of that and enjoy that as well. Give us a call at 855-226-8551 or email us at info@yourmoneyontap.com to schedule your Zoominar.
And now, here's our Cliff Notes edition of Money on Tap.
Joe Brasoulis, which is the chief economist for RSM US, he said money will no longer be free. And I think the idea that borrowing money at a rate so low that it's just kind of inconsequential that you even have a loan rate, which is what we've been living with, honestly, I think it's hard to quantify how free money has been. And we won't really understand that until rates really hit some excessive levels. The Fed raising rates, I think every 1% they raise it, that's at least a 1% rate you're going to see as an interest rate on any mortgage.
Thanks for joining us for this Cliff Notes edition of Money on Tap, with great tips from the pros in three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. Now here's more Money on Tap with Ben and Dan.
Welcome back. You're listening to Money on Tap. I'm Ben Brayshaw, and I'm joined here once again with Dan Michelon. We are partners and planners at Brayshaw Financial. For those who know our friend and partner, Seth, he is improving and he is doing better, and we are hoping to have him back with us on the radio soon. So thank you for your prayers. We appreciate that. If you have questions about inflation and you have questions about your portfolio or estate planning or financial planning or any of those type of topics, you can reach out to us. We do free consultations for people. We go through their concerns and their questions and see if we can be of help. You can reach us at 855-226-8551. You can also email us at info@yourmoneyontap.com. So appreciate everyone bearing with me as I get through this cold season, my voice. But thank you very much. And number 4, Dan, on our how to invest in inflationary times, how to inflate your portfolio. Number 4, we have the S&P. Boy, that's one that's just been tanking. Dan, tell me more about that.
Well, I think that's what makes it opportune to talk about right now is that, we previously mentioned if there's stocks you like that, are just down right now because the market's had that effect on it. You're essentially buying them at a discount if you're designed to hold them relatively long term. I think that's a good way to do it. But the indexes themselves, if you're not in a position to pick stocks or that's just not of interest to you, or if you want to pick some stocks but really foundationally build your portfolio out, bring in some diversification, just simple indexing is the way to do that, or a way to do that. And when you think about the history of our markets, over time, long view, they always move up. I mean, they have in the past anyway. And when you're looking at the S&P down 15% year to date and 20 plus from its most recent peak, if you have a few years to set the money aside, you can, there's a reasonable chance you can expect to get that as a minimum.
Yeah, and I think what, for everyone who's fearful, they're looking at their 401k and they're saying, oh man, I've lost XYZ because I had all this money in these index funds. It's like, if you're years off from retirement, you should be thanking your lucky stars this market's pulled back because there's so much demand behind all of these things. And the S&P 500, that's the 505 large companies in the U.S. And these companies, they have real demand. They have real business out there. These aren't small companies. Like people talk about the S&P 500 and realize this is 505 large U.S. cap companies. I mean, this is the business front. This is where your Apple and your Amazon. These are where these companies lie. And to know that this pullback has made that yield somewhere between 1.3 and 1.4%, the dividend. And it's really a really strong opportunity across the board in that, looking at some of these ETF holdings. So, this pullback opportunity is a great time to even look at getting in. It's a great time at looking at the yield if you're a yield focuser, saying, I really just want large U.S. companies. I don't want to pick stocks. It's a good opportunity there. And if you're years off from retirement, you're just buying all this stuff cheaper. Every month you put your money in. Every week you put your money in your retirement plan.
Yeah, some people try and time it and really land at that bottom, which is impossible to do. But, I got to tell you, if you're sitting on a reasonable sum of cash and you want a dollar cost average over these next 12 months, that makes a lot of sense.
That makes a lot of sense to me.
You'll find the bottom in there someplace.
Yeah, so some of those investments will be in there. I think that's one of the things that a lot of people run from is just not really knowing when to get in. And, I think about Mr. Wonderful. I would see him on CNBC, and he's like, when there's blood on the streets, you have to jump on in. It's funny, but he's right. It's like when you think the worst of the worst is happening and it's gloom and doom and it's all ready to implode, that's when all the people who know what they're doing start buying. Yeah,
it's some people would view it as, and this is, a matter of taste, but it's just a built-in discount.
Yeah, people say, oh man, it's going down. I don't want to lose it all. I'm going to get out. If you're that fearful of what's going on, you probably own the wrong thing.
Or it's the wrong time in your life, right? So this conversation is very different from, I'm about to retire tomorrow. That's a different circumstance, and that's a different conversation. We have, solutions and recommendations around that as well. But the notion of, hey, this might be prime time to get in is probably more relative to a longer time horizon than that.
Absolutely. Well, Dan, you want to hop on the next one? Start start
Yeah,
it off?
so a couple of government issue solutions here that are specifically designed to combat inflation are TIPS and I-bonds.
There's been a lot of conversation around this in the public communities. It's been interesting to talk to clients about these.
Yeah, I mean, treasuries is usually, honestly a pretty boring conversation. But these days it's taken on a different interest. And one of the primary reasons is these I-bonds, which is it's a 5-year issued bond, and it has a 6-month, guaranteed rate based upon when you issue it or when you buy it. But they're giving you rates specifically to combat inflation, it's in the 9% neighborhood.
Yeah. I mean, so basically what happens is the government looks at the their declared inflation rate, and that's the rate you get on these things. It's pretty phenomenal. The only downside, because otherwise we'd be putting a lot of money in it, is that with the I-bonds, you can only put $10,000 in. And then I think another $5,000 from your tax return, if it's a refund, you can put it in there too.
But if you have multiple entities, though, that's another thing. If you have corporations or LLCs, every entity that
no one's got 10,000 entities. Well, maybe Enron did.
But if you get 4 or 5, you can put 40, 50,000 in.
Yeah, no, it could make a difference. I mean, there's some real opportunity potentially there. I think the thing is that what a lot of people don't realize is, with the I-bonds, you can redeem them after 12 months. So you have to be in for 12 months. So if rates go up, you got great rates, and then they go down, you get better rates. That could possibly be an issue. But if you redeem it before 5 years is up, you actually forfeit the last 3 months worth of interest.
Right.
So if you get an I-bond paying 9%, and then all of a sudden it might not be 9% if you get rid of it in 12 months in one day.
Yeah, there's certainly a cost to doing business in that, but the good news is you can't lose your principal. You will make something. The question is how much of that interest are you truly going to take home?
Unless China calls all their bonds.
Well, there's always something.
There's always that in the background. With TIPS, I think the thing that makes TIPS and I-bonds significantly different, and again, Dan, no one wants to talk about this stuff like historically, but right now it's got some real action around it. TIPS are things that you can either buy in 5, 10, or 30-year increments. I think the thing is that it really comes down to tax differences, right? So at the end of the day, TIPS are taxed as ordinary income, and they're taxed annually. Where I-bonds, you don't face taxes until the day you decide to liquidate it, which could be 30 years out. Now, a lot of people talk about TIPS being purchased in retirement accounts because that way the taxes are deferred just like any other taxable event. But I think the real difference in the TIPS is that they're both inflationary protected. You can buy them, and TIPS are a little bit more liquid. You can sell them anytime you want. There's no backtrack. But the problem with TIPS is that you could see a loss in principal.
Yeah, once the CPI adjusts down, it's going to have that negative effect on your principal, not just the interest accrued. So there is an added degree of risk in there. So it is something that would require monitoring and is I think they're both relatively short-term plays, but the TIP you really need to be mindful of. Yeah,
and it changes every 3 months. So you got a little bit more activity going on and how they evaluate what those rates are. So very interesting because, here you're looking at 8, 9% potentially with inflation where it's at. And if you think inflation's going up for the next year, 2 years, 5 years, could be a huge play.
And if, again, counter to the I-bond, if you wanted to get into this TIP notion, or you think that's a wise place to be, there are some managed products as ETFs that are collections of TIPS that you can, count on some professional management built in there. So, they're buying them in all the different durations. So you can buy it on a day and sell it on another day. And, when you think that CPI is about to take a move in the opposite direction from where it's going right now.
Yeah, it's definitely interesting. When the tax piece really jumps into play, it really makes the decision more strategic around which one you go with, whether it's an I-bond or a TIP.
In which account you hold it in.
In which account, So, can you keep your income levels low? Are your income levels low theoretically? Maybe you're taking income from a Roth IRA, so you have no official income from the IRS. And, hey, a TIP would be great for your cash assets right now, maybe. Or if you have a high income, maybe, you got to be looking at an I-bond and say, I'm in this thing for at least maybe 5 years before I deal with a 3-month pullback on interest. So that's definitely some interesting stuff to really kind of address. Our number 6 is kind of interesting. We got 2 more here. Number 6 is REITs. We're back to real estate, Dan.
Yeah, there's it's a way to own real estate without feeling like you own real estate. It's more of an investment product, right? Something you trade like a stock or a bond or an ETF. But rather than participating in the market, whether it's the stock or the bond market, you're participating in the real estate world, and that you can buy it in a number of different variations, right? So it's not just real estate, quote unquote, in general, but if you think, in high inflation times, as an example, residential rentals typically do well, right? When mortgage rates are rising, home prices are already sky high, people rent.
Yeah.
So you can buy a REIT that's geared towards exactly that, residential rentals.
Which probably had pulled back because everyone was buying houses during those years. So there's kind of that thinking behind it. So REITs, which stand for Real Estate Investment Trusts, are basically groups of pieces of real estate, mostly geared towards a specific type. Like you mentioned, rentals. There's also storage programs. There's commercial office properties, that type of thing. So
just came across a couple interesting ones in the farming world, right?
Yeah.
So these REIT companies have bought up huge swaths of farmland and lease it to farmers.
Yeah. Very interesting space, usually driven by, and again, current income is really the play. The nice thing about REITs, I think what a lot of people don't realize is that, for REITs to keep their tax status, I think they got to distribute, it's 95% of their income out to their investors, which is an interesting, they have to do that. So that's really interesting. It's not like they can pocket the money. So it does force the money out. So you do have that income coming in, that kind of dividend yield space, and something on the traded space in the stock market. Yeah, there is some effect to the ups and downs of the market. You're going to see people who decide to liquidate certain assets and say, maybe they're selling real estate programs to offset the losses in something else, or a margin call, or something crazy like that.
But one of the benefits, though, is that it is considered a non-correlated asset, right? As a term we've used here before, where you wouldn't expect it to behave exactly like the market's behaving.
Yeah, absolutely. All right, as we wrap up this show, our last one is leveraged debt and corporate bonds.
Yeah, there's certainly as money gets expensive for corporations and what they're willing to pay for it, there's nothing wrong with being a lender in that sense, right? So you can buy corporate bonds that have a guaranteed return, at least as well as the company behind it can guarantee, right? So you're somewhat, tied to the fact that this company needs to stay in business and succeed. So you want to choose carefully, but the corresponding rate you get, that really determines your risk reward scale.
Absolutely. I think the other thing is like the idea, you say, collateralized loan or leveraged loan, that kind of has like some scary language around it from some of the historical stuff that's happened in the past. But when you start realizing like the idea around a collateralized loan and the idea that they're taking lots of loans that are maybe to big corporations and so forth, and they're bundling them together, that's really the focus, is to try to create a diversification inside that space to lower risk. And again, an income play.
Yeah, I think what it all boils down to is if you have faith in the U.S. economy, if you have a little bit of time horizon and understand that in all likelihood that this is a difficult time we're in, but it is temporary, that there are still opportunities out there. And we've run through 7 or 8 of them here today, but it's a conversation that we happily engage in. We'd be more than happy to take a look at what you currently hold and see if any of these suggestions that we've talked about here today would be a worthwhile change or shift in your portfolio that may be better suited to the short-term conditions and the long-term outcome.
Yeah, I think that's a really good point too, Dan. And there's here we've talked about a few of them. There are more ways to combat inflation, and not all of them solve inflation, but they help address it better too. There's things you could do and say, hey, listen, I really think I want to be in a short-term play that provides me with something better than zero at the bank, and I want to be ready to make the move back into the market when that time is right.
Yeah, there are options that are liquid but relatively safe for a difficult time, and they'll leave you in a position to pounce when you're just more confident in what's going on out there.
Yeah, and I think that's where the the girth of financial planning comes into play. It's like, how do we mitigate this? How do we do this? Where do we go? What do I do now? I've lost all this money, Dan. What do we do? How do we get there? And give us a call, 855-226-8551. You can reach us, talk to us, sit down with us. Free consultation. We offer that. We want to see that people really do have an opportunity to succeed. That's what's really important. You can also email us at info@yourmoneyontap.com. Thank you so much for listening today. Look forward to talking with you guys next week, and you make it a great one.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.
Well, bye.